Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. As many of you know, over the past 2 weeks or so, I asked on multiple different occasions to send me as many questions as you have, trading related questions, on my Instagram. So this video today is going to be dedicated to answer as many questions as I possibly can out of all of the questions that you have sent in. So if you get value from this video, make sure to press the like button down below. If you're new, press the subscribe button. Welcome to our community, welcome to our family, and I'm looking forward to see your thoughts in the comment section down below. Now in this video today, we are going to be discussing many different topics, as the questions that came in cover a very wide range within trading, within foreign exchange trading. And we're going to be discussing concepts such as institutional candle, Wyckoff, market structure, to more psychology related stuff, my personal experience within the financial markets, how long have I been trading, to speaking more about something that lots of you have been asking about, which is more resources about these concepts, mentorships that we do, some courses that we have access to, and some other general questions that you have sent in. So let's go ahead and jump straight into it. I'm going to start off with the more psychology related questions, or questions in regards to my personal journey within the financial markets. The first question is, how long did it take you to see profits consistently within the financial markets? I started to trade back in January 2018, and in the whole of 2018 and practically for the entire 2019, the concepts that we were using was your typical support and resistance and trend lines, Fibonacci. If we were feeling a little bit more advanced, we would use MACD divergence or RSI divergence, price action or candlestick formations alongside of our analysis, plus a couple other tools. I actually experienced consistency using the same concepts that we don't use right now. It took me probably about 7 months or so to get to that stage, for me to learn these concepts, to then become independent analyzing these concepts on my own. I would never say go based on how many days or weeks or months or years it's taken some other people to get to where they are. Ask them how many hours they have put in their journey. If you want to become consistent using smart money concepts and Wyckoff, you have to aim to put a few hundred hours in your education. I would say I had my breakthrough in trading after around 2 years of me trading properly. A lot of people get way too invested in trying to force their breakthroughs, but the reality is, so long as you're putting the hours, so long as you're doing your chart breakdown, so long as you're practicing, then your breakthroughs are going to happen one way or another. Next question is there a certain amount of time you give yourself when marking up charts? The straight answer would be no. However, if I find myself spending way too much time on one currency pair analyzing it, I normally stop myself and move to the next one. Something that I have found, especially within my journey, is when you spend way too much time trying to analyze a chart, that normally could mean that you haven't actually managed to find a clear directional bias, and the rest of that is just you trying to force the analysis, you trying to tell the market whether it should go up or whether it should go down. And oftentimes you will see that those analysis will come out wrong later on. When you look back at it, you wouldn't even understand why you bought or sold it where you did. So the answer would be no. There is no set period of time that I would give myself, but I wouldn't want to spend way too long analyzing the same pair. Next question is asking about the biggest hurdle in the trading journey, in anyone's trading journey, and how to overcome it. I would honestly say the biggest competition with you in the financial markets is yourself, is your mind, is your psychology, and is your control over your emotions. So long as you are at a calm psychological place, so long as you're developing yourself as a person every day, so long as you're in full control of your emotions, then you have a much higher chance of success within this industry. Next couple questions that came in regards to trading psychology, we're talking about how to stay disciplined in the financial market and how to avoid taking certain trades that have not agreed with your analysis, because sometimes fear of missing out pushes you to execute trades without those trades actually matching your confirmations. So how do you control yourself in those scenarios? I'm not going to speak too much about this. I'm going to link the trading psychology video down below in the description. Do make sure to watch the trading psychology video, because I cover many of these concepts in my trading psychology video. However, something that I will say is, don't look for ways to become disciplined. Don't look for ways to avoid a certain mistake. Don't look for ways to grow your emotions, your psychology. Just do it. The fact that you're looking for ways, the fact that you are looking for, I'm going to say, hacks to become better as a trader in terms of your psychology, it shows that you're not probably putting the hours necessary in your personal development, which is at the end of the day the best way for you you to actually become a more intelligent or emotionally intelligent trader, I'm going to say. So don't look at it as how can I become more disciplined. Look at it as I need to be disciplined, therefore I am disciplined. And from tomorrow, be more disciplined with your trades. Don't execute a trade when it doesn't match your set of rules. We want to always do something wrong and then give an excuse after as to why that thing was wrong to do. Well, instead of doing something wrong and then give an excuse later on and saying I got greedy, or I had fear of missing out, or this trade really made me understand the importance of trading psychology, just understand it from the beginning and don't make those mistakes. As simple as that. But do watch the trading psychology video. It will help you a lot. That's all in regards to trading psychology and about my journey in the financial markets. Now let's move on to questions about institutional candles. The first question that came in regards to institutional candles is when you have multiple different points of interest, multiple different points of entry within the same trend on different time frames, how do you decide which one you actually go based on? Now that's a very good question. However, I need to do a training on its own for that one. Otherwise, this video is going to be very, very long. It probably will be very long anyway. But the best way that I can go ahead and answer that question is always stay relevant to the price. If one of the institutional candles you're looking at is hundreds of pips away from the price, then you don't necessarily need to take that into account as of yet. Once the market approaches that level, by all means, you can have a look at it. So that's the first way to get rid of some of the institutional candles that you have marked up. Maybe you've marked them up on the higher time frames and they're extremely far from the price. Stay more relevant to where the price is. From there, if you watch the GBP USD video that I posted some time ago, in that video, again, I'll link it in the description below, I actually speak about multiple different points of entry within the same analysis. You can see the analysis before, during, and after, and how I decided to only take one of the trades after having multiple different points of entries marked up. So hopefully that video will answer your question. So many questions came in regards to entries for institutional candles. I'm going to cover 2 or 3 of them in more depth. The first one was if you need to wait for accumulation and distribution before entering based on an institutional candle, or what other confirmations do you generally need to wait for when it comes to institutional candles. It really does depend on what time frame you're looking at. So if I identify a 4-hour institutional candle, I wouldn't necessarily want to enter based on the 4-hour time frame. I would want to enter based on the lower time frames to have much smaller stop losses and potentially better risk to rewards. So because I've marked up a higher time frame institutional candle, I would not enter based on that. I would want to see price action at that level on the lower time frames. So once the market approaches that higher time frame point of interest, I'll zoom into 15 minutes or lower to see if the market is accumulating or distributing at that institutional candle on the lower time frames. And if I see that, then I will trade based on that. You don't always have to wait for accumulation and distribution at institutional candles. Of course not. You don't have to wait for that. The reason I might do sometimes, not necessarily even all the time anymore, but sometimes I do wait for more confirmations before I pull the trigger, is because I'm very picky with my trades. As simple as that. You don't need to be. In terms of what other confirmations you would want to see before entering based on an institutional candles, it's many confirmations that you need to see. Market structure being one of the most important ones. A lot of people identify imbalances and institutional candles and are extremely confused why the market keeps going past them left, right, and center, hitting their stop losses, thinking that, damn, these strategies were meant to actually get me paid. Now they're actually making me lose more money. The reason behind that is because you're going based on a very small part of the entire theory, of the entire school of thought. You have to make sure you have other confirmations parallel to your entry confirmation. Market structure is the biggest one. You cannot buy based on an institutional candle if the structure is screaming it's going to go lower, if it's a bearish trend. There was another question in regards to time and price relationship for institutional candles. So does it matter what time it is? I would say so, yes. Time is definitely an important factor when it comes to analysis. I would majorly want to trade major currency pairs, being the US dollar currency pairs, during New York session or London New York overlap, for example. These times would be excellent to trade the US dollar currency pairs. I would not necessarily want to trade Euro USD or AUD USD or these pairs during the Asian session, unless there's other things going on. But on a normal day-to-day basis, yes, I would say time is also an important factor for institutional candles. There was many more questions questions that came in regards to institutional candles, but I cannot be answering every single one of them on this video. A lot of them I've actually answered on all of the previous videos, such as the next question, which was, can you make a video about institutional candles, going into detail about them and how we take trades based on them? Well, to be fair, I have actually done that already. So there is an institutional candle video that you can watch on my channel. Again, I'll leave the link down in the description below for you all. Do make sure to give that a watch if you haven't already, and that should answer many questions that you have in regards to institutional candles. Now, the question that I think a lot more people have been waiting for, which is, how do you get access to more resources or my personal mentorship or the course that I am personally involved in? What platform am I currently partnered up with, etc, etc, etc. Now, there's a reason why I have not been able to get back to many of you on Instagram, and that reason is I'm only human. Probably. So, I have my own limitations as well, meaning I cannot possibly be getting back to so many people asking for mentorships and courses and resources. So to make my life easier and to make your life easier, over the next week or two, I'm planning to relaunch my website, pipsofpersia.com. On that website, there will be multiple different sections for you to be able to get access to more resources, or for you to get access to the platform that I'm partnered up with, full information about the platform, full information about the course, and how you can become a partner within our platform as well. So bear with me. For now, you have access to many videos that I have put on my YouTube channel and many videos that I will continue to provide for you guys. But just bear with me. So I relaunch my pipsofpersia.com website, and once that's done, you shall see the updates on my Instagram. So stay tuned for that. On to the next section. The next few questions is going to be based on Wyckoff or general market structure, with the first question being, do you always take into account the overall market structure when executing a trade? Now, it really does depend what you mean by the overall market structure, but what I assume you mean is the higher time frame market structure, because sometimes when you're on the weekly time frame or daily time frame, you can see a bullish trend. But once you zoom into the hourly or 15 minutes, that completely changes to a bearish trend. Now you're confused, thinking, which one of these trends am I meant to stick to? Am I meant to be bullish or bearish on this specific pair? I stay relevant to the price, as mentioned earlier. So I don't want to necessarily take into account a weekly trend if I know it's going to take me either weeks to get in a trade or weeks and months to get out of a trade. Now, if you're a position trader, that's absolutely fine. Do that. But I don't consider myself a position trader. I consider myself a swing trader, or at least a little bit longer term intraday trader, let's say. But just stay relevant to the price. If you see that your structure points are hundreds, thousands of pips away from where the market is right now, then you probably don't necessarily need to take them into account yet, at least. Now, this doesn't mean I always only start looking at structure points at, for example, the hourly or the 15-minute time frame. I would have it in the back of my mind what the higher time frame structure is. However, I would want to stay more relevant to the price. And that depends on the type of trade that I want to take. Do I want to be in and out of this trade very quickly? So, for example, my analysis may even start on the 15-minute time frame, or do I want to spend a little bit more time in this trade? Do I see that this market is likely to have a larger move? Then my analysis most likely would be based on slightly higher time frames. Next question is if I can speak about key schematics that would indicate reversal. To be completely honest with you, I feel like what this channel is majorly about, although a lot of the trades that we take are continuations, not reversals, in a lot of the videos in this channel, we have given full information about accumulation and distribution. And these are the schematics that will help you spot potential reversals based on the time frame that you're looking at. But one thing that I would say is you shouldn't necessarily aim to always catch the reversals. The person who always tries to catch the top or the bottom of the market, in my opinion, is a very egotistic trader, because markets are generally continuations, not reversals. It's amazing that you're catching the top or the bottom of the market. Well done to you for being an absolute sniper in this market. But the aim is to create wealth, and wealth is created with going with the general trend, going with the general structure. And that comes with trading continuations, in my personal opinion, at least. So you can aim to not just want to trade reversals, learn about continuations as well. And through learning more about accumulation and distribution, you will learn how to spot reversals a little bit easier. Next question is a very good question. Do you consider the market reaching below your zone of support, but not closing below your zone of support, as a break of structure or not? Now, there's multiple different ways I can answer this question. First things first, if you're looking at the 5-minute time frame, you might see a lot of candlestick closures, but when you go on the higher time frames, all of those candlestick closures will turn into wicks. So it's quite difficult to answer that question. It depends on what market you're looking at, depends on the time frame, depends on what you see there and then analyzing the charts. But what I would say is, for me, a break of structure is the market spending a little bit more time on the other side of the zone. But more than looking at it from a structure perspective, I encourage you to look at it from a supply and demand perspective. Because if we have had significant supply to the point that this market has had a major decline, reaching below previous points of structure, then most definitely that's important, and that's something that I will take into account, because at the end of the day, the market has reached below previous zones of support or resistance, let's say reaching above a zone of resistance. So in those cases, with supply and demand analysis, yes, I will take it into account. Many more questions came in regards to market structure. I feel like a lot of people are confused about the true structure and how to identify the true structure. In the near future, we might end up recording videos breaking down structure properly. That's not something that I have within my plans yet. In the future, we may do that, but as of right now, what I would encourage each and every single one of you to do is use your existing knowledge and spend 50 to 100 hours on the charts analyzing structure points on different time frames and different pairs. That will help you a lot, especially when you see what happened to the market after certain violations or respects of structure points. Moving on to a little bit more Wyckoff related questions. The first thing that I would say is that many questions came in regards to using the volume indicator alongside of your accumulation or distribution schematics. I'm not going to comment much on that, simply because I do not use the volume indicator alongside of my schematics, as you have seen on the other videos. I personally don't think that that's a major part of Wyckoff. I know it's very widely studied and practiced, but I don't use it, hence I'm not going to really comment on that part of things. But talking about the schematics itself, one of the questions is the Wyckoff schematic valid when, let's say in distribution, the liquidity is taken out by the upthrust or upthrust after distribution? Yes, within a distribution, we would want to see a manipulation of the highs, so liquidity grab to the upside and a break of structure to the downside. A break of structure after a manipulation of the highs would make a distribution valid. Vice versa, a break of structure after manipulating the lows would make an accumulation valid. I'm going to rephrase that slightly better. A break of structure to the downside for the distribution makes it valid, and a break of structure to the upside for the accumulation makes it valid. Many of the other questions that came in regards to Wyckoff are questions that I have answered many times in many of the different videos, such as reaccumulation and redistribution schematics. Within my redistribution video, there are 2 pictures in the video that you can pause it and screenshot for yourself to have access to redistribution schematics. And in the reaccumulation videos that we have posted, you are also able to get screenshots of certain schematics. So I encourage you to watch those videos and get answer to your questions over there. In regards to supply and demand, when it comes to Wyckoff, again, that's one of the concepts that we have spoken about a lot, especially in the redistribution video, but that's going to be one thing that we will speak about in the future videos as well. But generally speaking, a distribution is a zone of supply, an accumulation is a zone of demand. A reaccumulation is also a zone of demand, a redistribution is a zone of supply. As simple as that. Final question about Wyckoff was about a more basic understanding about what Wyckoff is and a more of a basic tutorial on what Wyckoff is. I haven't recorded a video on a basic level for Wyckoff yet, at least, but hopefully once pipsofpersia.com is launched, you will be able to get that information through the resources that I give you guys there. But as of right now, I recommend just study it on your own. Based on the videos that I have posted, take the schematics away, go on your charts and spend time until you learn what they are. Moving to our last set of questions. These are questions that didn't necessarily fall under institutional candles or market structure or Wyckoff or trading psychology or my personal journey. So I'm going to answer as many questions as I can. However, some of these questions I am really not in the position to be able to give a clear answer about, such as how many trades do I recommend to take every week, or for example, whether I would recommend to have trades open overnight or have trades open over the weekend after a session closes or during a session opening, etc., etc. The reason I'm in no position to answer these questions is because I don't know the style of your trading. I don't know how much you risk. I don't know how much your potential reward is. I don't know what strategies you are using to analyze these charts. I don't know how long you have been trading. I don't know how in control you are of your psychology. I don't know what risk you are taking per every trade on your account. I don't know a lot of crucial information that I need to know for me to answer the question that you have asked. So I'm not going to be given a clear answer for these questions, but what I would say is if it feels wrong, don't do it. So if it doesn't feel right to have many different trades open in the same day or week, then you should probably stop. You should probably bring it down. The main point of trading is being able to preserve your capital and grow it with calculated risk. So if your risk is a lot, stop. If you're too scared to execute a trade, also stop. What concepts do we actually use to analyze these charts? What is our school of thought? Our school of thought falls under Wyckoff and smart money concepts. So Wyckoff is obviously the schematics that you have seen that we have talked about. Smart money concepts, more information about institutional candles, imbalances, and many different concepts that we use to analyze the charts. That's the school of thought. However, that doesn't mean we purely rely on that. There's many different things that we take into account, such as seasonality in some cases, the fundamentals that come out, different news, and how they can affect our trades, market structure, etc., etc., etc. But generally, Wyckoff and smart money. Do you have a strategy on how to trade the London breakout sessions? I don't trade the London breakout myself. However, I know many traders who are trading smart money concepts do actually trade London breakout based on manipulations and institutional candles to catch some of these amazing moves that happen at London Open. Since I don't trade it, I'm not going to comment on it. What are the differences between a true zone of supply and demand versus a support and resistance? Well, technically support and resistance are at the end of the day zones of supply and demand, but on a much smaller scale. A support zone is a minor zone of demand since the market keeps bouncing up from it. Clearly, some element of demand has been introduced to the market at that zone of support, vice versa for the zone of resistance as a zone of supply. However, in my personal opinion, what we can consider a true zone of supply or demand are zones that after that we have gotten violations of structure points, zones that after that we have had major moves in the market. That is what makes a difference between supply and demand and support and resistance. What is the first thing you look at when you analyze a chart? One of the first things I always look at when I analyze charts, where whatever time frame I'm starting from and keeping it consistent on practically all time frames that I look at, is where have we manipulated the highs, the lows, or the trend lines. So when I'm looking on the weekly time frame, I want to see where have we taken liquidity. Daily time frame, same thing, 4 hour, 1 hour, 15 minutes, 5 minutes. I always want to see where have we taken liquidity, where have we violated previous highs or previous lows or trend lines. These are going to be areas of interest because chances are some type of an institutional candle should come out of these manipulations, which I can later on base my trades on them. How do you decide when to take partials in a trade or stay in full position until take profit? Our main aim is to preserve our capital and have calculated risk. So whenever possible, we want to take that risk off the table. Hence why we would move our stop losses to break even when the structure is agreeing. Hence why in practically all of my trades, I close partials. When you're closing partials, you have to remember that it will affect your risk to reward. Because if you're looking at a 10 pip stop loss and a 30 pip take profit, and you close half of your positions at 15 pips in profit, then your risk to reward is not 1 to 3 anymore. It's much less than that. So calculate how it will affect your risk to reward and close partials. You don't need to stay in the full trade with your entire position. You want to be able to preserve your capital. So always take some positions off the table. This very rarely happens, or doesn't happen at all right now, in fact, that I would have all of my positions running until the final take profit. Normally, no. I would close partials along the way and take a percentage off the table, always. Do you trade indices? No, I don't trade indices. Not that I have anything against indices. I personally just do not trade them. I know a lot of very successful traders who only focus on US 30, for example. Doesn't mean you shouldn't trade it. I personally don't. My personal focus majorly is just currencies. What is the best strategy that has worked for you trading gold? Again, gold is actually another asset that I personally do not trade. I have nothing against gold, but I personally do not focus on it. Something that I will say about gold is in the past 3 years, every single year there has been a hype built around a new methodology to trade gold or a new strategy, and this brilliant way is going to pay you a lot when it comes to trading gold specifically, and every single time after a few months it disappeared. It was nowhere to be seen. And many of these strategies always focus on catching very small portion of the market but using much larger risk per every position that's executed. So in reality, it's not actually a good strategy or a majorly profitable strategy with, let's say, good entries or catching a major move in the financial markets. It's mostly just big lots for that given account size, making it look successful. So if you want to trade gold properly, do not learn from someone who has only been trading it for a short period of time. Learn from strategies that have stood the test of time. So you want to understand gold from an institutional standpoint. Gold is safe haven. It's going to be invested to here and there at times times of economic uncertainty. You need to know how to understand it from a safe haven perspective, from an institutional standpoint. So my recommendation would be learn what gold is, what is the importance of gold in the financial markets, not just in terms of precious metals, but for currencies, for cryptocurrencies, for many, many different stocks, etc., and how it relates to the global economy. Once you know these things, whether you want to intraday trade gold or whether you want to swing trade it and position trade it, you're at a much larger advantage of your trades being correct. Next question is about FTMO. Any tips on how to pass FTMO? To be completely honest with you, I wouldn't really be able to answer that question since I'm not on FTMO accounts. If you don't know what FTMO is, it's just a proprietary funding trading platform out there. But for any of you who's looking into FTMO, the biggest advice that I would give you is know that you have to keep it consistent in terms of your strategy and your emotions. When you're being tested for whatever it is, naturally we want to prove ourselves. And because we want to prove ourselves, we end up taking wrong trades. We end up executing too early, or we end up going against our risk because we want to hit that target quicker than anyone else. Put that out of your mind. Make sure you approach it from a calm state of mind. Continue what you have been doing so long as it has been working. Don't let these little psychological mistakes throw you off. And before applying for the actual test, I highly recommend do the actual trial for it. Get a feel of everything and see if it works for you. We're approaching the final questions. The next question is in regards to tax and when you have to start paying tax when it comes to trading. Again, I would not be able to give a clear answer because we have people watching this video from all parts of the world, and trading regulations is going to be different in different countries, and you have to check that with an accountant that is based in your country, working based on the trading and tax laws of your country of residence. Speak to them. Don't trust Google when it comes to trading tax because there's a lot of misleading information on Google. In UK, under HMRC regulations, trading is indeed taxable, so I do recommend to find your own accountant. You have to start worrying about tax once you withdraw £12,500 for trading and when you cross that threshold of earning within a tax year. But I highly recommend find your accountant, reach out to them and have this conversation with them. But with that being said, that brings us to a conclusion for our video today. Thank you very much. If you stayed until the very end, I hope you gained a lot of value from this video. Don't forget to like down below, press the subscribe button. If you're new, again, welcome to the family, and let me know what you think in the comment section below. Now it's time to apply the stuff that you have learned. So I'm looking forward to see more success stories being created over the next few months and years to come. Take care. See you next week.